Hello and welcome to Business Standard. Today we have with us certified financial planner from Mumbai, Kiran Telang, who is also an author of a very interesting book on retirement called Mindful Retirement. Yeah, so Kiran, my first question is, why is it important that all of us take retirement planning very, very seriously in India?
Well, Bindisha, this is a very important question indeed. See, what happens is that retirement is a goal that everybody has. I mean, whether they are working, not working, whether it's a lady who's a housewife, retirement planning becomes a key for everybody because that is a phase of life where there'll be no other source of income for you unless you invest and create a pool of money for yourself. It will be very difficult to sustain and maintain the lifestyle. So if we look at a simple calculation, people usually start working by the age of 20 to 25, depending on what field they are in. And typically the retirement age is anywhere between 55 to 60 years if you're a salaried employee. If you're self-employed or if you're running a business, you can obviously go longer. But even with people who are self-employed or who are running their own business, there could be issues with physical health, cognitive health, which can impact the performance in the profession or the business, and there might be forced retirement at some point in time, or they themselves would want to step back and take a break. So in that scenario, when you're talking of say typical earning years from say 25 to 60 years of age, that is 35 years of your life. And nowadays with longevity, we see people living to 90 and 100. So if we even talk from 60 to 90, that is 30 years of your life where you will have to depend on one source of income if you don't really have any kind of pension coming in from your employer. So for most part of the Indian diaspora, we know that except for bankers or people who are in the defense forces or government employees, there isn't any pension available. So one has to figure out for oneself how are we going to sustain in those 30 years. So you earn for 35 years and you spend in this 35 years, and at the same time you need to save for the remaining 30 years of your life. So unless you start very early and do it in a disciplined manner with a very focused goal approach, it will be very difficult to build the kind of corpus that you need for sustaining your lifestyle in retirement. So I guess that is a longish answer to why retirement planning is important.
Okay, so in your experience, what do you think have been the biggest mistakes that people make when it comes to retirement planning? If you can share a couple of mistakes that people make.
Well, I would not really, call those as mistakes. I would rather say that our mindsets are very different. Though things are changing. I mean, over the years when we've been talking about in various forums about the importance of retirement planning, people have realized that yes, it is an important part, but still there is a huge, proportion of the population that is not really doing anything about their own retirement. So one thing is not taking retirement seriously. Second is that we will do it once we are done with all our other goals. So things like, I mean, things take priority. Buying your own house, providing for your family, and education goals. Those things take priority over retirement planning. So you lose the initial 10, 15, 20 years of your career in postponing, in pushing that goal forward. So that is where the urgency then comes when you are maybe 50, 45, 50, that okay, you've not really done anything seriously about retirement, and what do we do now? So I think that lost initial number of years is a critical time when you can actually build in, even with whatever little bit you have, say 10% or even 5% of your surplus that you have from your income, if you can divert it towards a fixed goal towards retirement and do it over a long period of time, I think compounding can work real wonders, and you can create a huge corpus for yourself. So I think that mindset change has to happen, that it has to start early with whatever amount you have. Even if you have a smaller income in the initial part of your career, it's very important that you put some small amount aside for retirement so that it builds up gradually over your earning years.
Yeah. So for people to understand, obviously the math is a little complicated, but if there is a ballpark figure, like a thumb rule or a ballpark figure, how much does a person requires for retirement planning?
See, if you really want a thumb rule, I will say it's a thumb rule. It will differ for different people, different kinds of families that are there. I would say something like a 25 to 30 times your annual requirement at the time of retirement. So annual monthly expenses, so if you need 1 lakh a month, that is 12 lakhs a year, that is into 25. So that is what you will need to have at least at the time of your retirement, assuming that all other things are taken care of. I mean, there are no other goals like, taking care of your children or who are still studying, or, providing for the
Right,
marriages
right,
or buying your own home. I'm assuming that everything else is done and taken care of. So this is for living expenses and lifestyle expenses.
right,
So
right.
that is the bare minimum that you need to have a comfortable living. So
Yeah,
that could be called a thumb rule. Obviously, as I said, it will differ from family to family and different situations.
right. So a lot of salary people actually believe that, I have EPF savings, so that will take care of it. So do you really agree that EPF is more than enough, or will it create a deficit?
In most cases, I feel it will need a buffer from your other investments, because typically what happens is EPF is 12% of your salary that is going into EPF over your earning years. And if there has been a break in the career, obviously those years there has been no investment. So typically what we see is people come with a couple of crores with the EPF money maturing, and that usually is not sufficient to sustain the kind of expectations they have from their money at that juncture. So I feel definitely, I mean, unless of course you are like very, very high salaried individual, the CXO category, then probably your
Mm.
salaries are high enough to, give you that kind of corpus to sustain your lifestyle. But again, on the other hand, if you have that kind of income, your
Mhm.
lifestyle will obviously be in a similar range. So it's
Mhm.
like a catch 22 situation that you have more income and your lifestyle is much higher. So definitely, I would say better to have something extra than just rely on your ETF.
Yeah. So in addition to EPF, should a salaried what should a salaried person save? Like, what are the products should a salaried person save for retirement?
See, the products keep on changing, so what products are available now might not be available 10 years down the line, or what we had earlier are not available today.
Mm.
So the critical thinking part in this, goal planning is that you need to have something that beats inflation. That is one, and
Mm.
second, something that grows over a period of time. So obviously, I mean, beating inflation becomes a part of it. So something like an equity investment, whether you're doing it through direct stock purchase or you're doing it through the mutual fund route. So that is one of the good options, because if you have a very, very long time horizon, then it makes sense to put money into equity. It will grow as per the growth of the businesses and the economy, and it will give you a good corpus. And
Mm.
of course, it keep changing. The strategy keeps changing as you near retirement. You have to kind of balance your portfolio, because if you've been saving from the age of say 25, 30 towards retirement, there'll be a sizable corpus which is built closer to your retirement age. And if it is only into equity, then you probably might end up taking a large hit if there is a major crash. So your basically there is a concept called a sequence of events risk. So if you
Mhm.
have a substantial corpus and into equity, and there is a crash closer to your retirement, you go down drastically on that corpus that you've built over the years. So to kind of protect what you've built, you need to diversify a little bit into debt, or gold, or other asset asset classes or other products, which will protect some portion of your corpus that has been built.
Right. So this was for salaried people, but people who have their own businesses usually redeploy a bulk of their savings into their business itself in order to make it grow. Now, what would you suggest them to them vis-a-vis retirement planning?
I think this is a big issue, with most business owners, that they feel that their business gives a lot of return. I mean, what you will earn from other asset classes. So they feel their businesses give better returns. But
Mhm.
I would only say one thing, that what if you are not there in the business to run your business? So the
Mhm.
business is earning those kind of returns because you are a part of that. Tomorrow, if something goes wrong and you are not able to run your business, then what? So then it is better to diversify into other businesses. So when we talk about equity investing, it is essentially investing into various kind of businesses, various other companies from which you will get the return, which is in line with growth of that company. So it is better to diversify your risk. Just having all your investment into one company, which is basically your own business run by you, you are running a huge risk. And especially in terms of retirement, also, when you want to take a break, your cash flow could be very good from your business, but there should be other sources of income. So if you're taking a break from your business, either you sell it. So when you plan to retire, either you sell it or you bring in other people who will run the business for you while you still continue to own it. So there are several such strategies which can be done, but they are not as easy. So it's
Okay.
better to have an alternate stream of income which does not depend on what you're doing primarily.
Okay. So what are the products that currently, what are the products that a business person or a self-employed person could look into for retirement planning?
See, all money or all financial products are gender agnostic. They are agnostic to what you are into, so products are there. Now you
Okay.
have to see what is suitable to your particular
Okay.
situation.
Okay.
So, as I said, retirement, I think equity is one of the very good options to get into. Real estate is something, again, which gives good returns over a longer period of time. But I mean, there are other factors in real estate which kind of I would say that it would be second to equity if you're thinking of a long-term investment, because it's a big ticket item. The transactions are opaque, though things are getting better now.
Mm-hmm.
And it's a little difficult to sell. I mean, with equity, whatever form you have in, you will get the money within a day or 4 days. So depending on what you've invested in.
Mm-hmm.
And with real estate, that becomes a problem. So you need the money, say in 10 days or a month. You cannot sell your property so soon. So there are
Right.
issues. So I
Mhm.
think equity is, as an asset class, is one of the better places to be in terms of retirement planning.
Okay. And what would you suggest to people who've woken up very late? They're in their late 50s or late 40s and suddenly now, realize that, oh my, I have only 10 years left or I have only 15 years left. What is your suggestion to such people? I'm sure there are a lot of viewers like that.
Yeah. I'm sure there are a lot many such people, and it is very unfortunate that they have to be in that position, because it's not an easy place to be in.
Mhm.
So while it is possible to still do planning, but it becomes a little more difficult. So it's like studying for your exams just a month before the exams are due. So something like that. So you have to be more serious. You
Right.
have to be more disciplined, and there'll be more expectations in terms of the amount that you need to save. So something that you could have done in your 20s and your 30s with, say, a 10,000 a month kind of investment, you will probably need, say, 60, 70,000 or a lakh, depending on what kind of income expectation you have in your retirement. So the quantum of investment goes up. Probably you will need to take a little bit more risk in your portfolio. You might or might not be comfortable with the kind of risk. And obviously, if you've taken the risk and the risk plays out, so you're investing in equity and the market crashes and there is nothing happening for next 4 5 years, that risk is going to be there. So that might lead you in turn to extend your working years. So if you're retiring at 60, you might have to work for a few more years so that your corpus is sufficient enough to last you for a lifetime without having any other source of income. So yeah,
Right.
it is possible, but it becomes that much more difficult.
Right. So there is this group which is woken up only at 40 and 50, and then there is another group which is emerging, which is like pretty much like a fire movement, like, financial independence, retire early. So, many people also aspire to retire early. So what would you advise? What would your advice be to them?
Well, I would say that there are two aspects to retirement, or rather three aspects to retirement, I would say. One is the money part, which we have been discussing so far. Second important part is your time. What do you do with your time? So, if you're talking about retiring early at the age of 40, if you don't have anything worthwhile to do, imagine 50 years of vacation.
Right.
You just sit at home for a month, you'll really get bored. And if you've been used to working very hard because, you want to do that retiring at 40 and 45, you've totally thrown yourself into work. So most likely your health would have suffered because
Okay.
you wouldn't have the time to really take care of yourself. So health is another aspect. So if you're not healthy and you don't have anything worthwhile to do in your time, what do you do after retiring early? So ask yourself that question before going towards that goal. A lot of people do have things in mind. They want to work for something that is their passion, but would not probably pay as much as the typical corporate work would give. So in that scenario, yes, you can definitely look at planning your retirement early. So then the most important part becomes that you start saving very early, right from your first salary, and save a substantial part of your income. So that is one. Second, being frugal can help. If your lifestyle is manageable within much less than what a typical urban person would be spending, then definitely your corpus required would be much lower. And obviously, if you have something in mind that you will be working for, say, some social cause, or something to do with creative arts or things which will pay but at a lower scale, so there is a very high possibility that your daily living expenses will be taken care of by that income, and your actual retirement corpus still has a longer time to grow. So if you have saved something from, say, age of 22 to 40, you have a pot of money there, and that still has time to grow till, say, 50 or 55 before you actually dip into it to meet your expenses. So I think it is very much workable, but those points of clarity need to emerge, and that is a very individualistic, a very personal thing that each one has to decide for himself or herself.
Right, right. So obviously now we've reached a place where in the interview where I'll ask you about the distribution phase. Like we've spoken about the accumulation, and now someone has gathered that 3, 4, 5, 6, 7 crores and is on the day of retirement, and then the new life begins. So what are some of the biggest mistakes that people make post retirement phase in terms of managing their corpus?
I think that the transition is it's a very period of high anxiety, I would say,
Okay.
because you've been used to a certain income coming in at a timely interval, and then
Right.
suddenly that income stops. So that psychological impact of not seeing that credit in your account at end of every month is huge. And then there is anxiety about whether we will have enough money for our lifetime, or we will have to ask our children for money. So the dependency factor, that anxiety does come in. There could be things where the children are still studying, or there could be children who are not yet married. So typically Indian parents would like to provide for the marriage as well. And there could be other goals, like you've not really had a house of your own, so you would want to buy a house, or you want to upgrade from what you've had so far. So there could be various combinations of anxieties that people have. There could be people who don't have children, so how will we manage if there is only one person who will survive? There could be people who are single, either unmarried or divorced or widowed. So different circumstances, different kind of families. So I would say what happens at that time is, because of all this anxiety, there are decisions which might go wrong. So somebody who's feeling very fearful at that time might allocate a huge chunk of money to asset classes which are probably not going to sustain them for a very long period of time. So imagine somebody putting that entire money into a fixed deposit. So fixed deposit is not actually a very tax efficient way of investing. And especially if you're investing for a period of 30, 40 years, everything cannot go into one asset class. Or, people go run behind things which are offering very high rate of return. Say, there are these cooperative societies which offer very high rate of return. Or there could be, recently we have seen the crypto mania which has happened.
Right.
So there could be these get rich quick schemes. So once you have the money, you might get lured into getting into these kind of schemes. So that is a big no-no for people. I mean, please try and avoid these kind of schemes which might actually, dent your retirement kitty in a major way. So just avoid that kind of a thing. There could be other things where, there is a large chunk of money which they might give away to their children for, business or things like that. So before doing that, just analyze how is it going to impact your own independence. So if you're giving a large chunk of money away and you're left with very little, you might not have that kind of income that you really need to sustain your lifestyle. Or you could have that kind of income, but the money will get over pretty soon. So you will have lot many years where you don't have money and you will have to get dependent on children. So be a little mindful of things when you're planning to give away your money. Similarly, not only giving away to family, but also moving, upgrading your homes. If you're putting a large chunk there, you're eating away into your kitty. Do you really need that? So these are the things that you need to be really careful of when you're planning to use the money that you've collected so far.
Okay. So what is this 4% rule, and does it make sense in an Indian context?
See, what the 4% rule means is that you have a certain corpus of money and you keep drawing 4% of the total amount that you have every year. In this manner, you will kind of not utilize all your money before your lifetime is over. So 4% rule is more prevalent in the US. I mean, that's where it originated, and it might not really be very useful in India because there are different strategies. This is one of the strategies for retirement planning. So there are different strategies that can be used for different circumstances that the client is in. 4% rule. So if you, simply saying your money has to earn more than what you're withdrawing. Right. So if you're earning a rate of return of 6% on, say, a fixed deposit or say a debt mutual fund, and you're withdrawing only 4% out of the total corpus. In that manner, your corpus, your capital is actually growing at 2% every year. So it is unlikely that you will run out of money in your lifetime. Right. So what can go wrong in the strategy is that if you make other lump sum withdrawals in between, so you have a requirement of a holiday, or you're upgrading your house as we spoke about, or you want to give some money to your children, so you make a large withdrawal out of the corpus. In that scenario, that 2% gain might not be sufficient. So depending on the circumstances, as I said, it might or might not work. In certain cases it might work, certain cases it might not work. So there is no hard and fast rule that it should work at a 4% withdrawal rate.
Okay. Now, suppose that a person has retired and he would want a regular payout to meet his living expenses, and would also want a part of his corpus to grow at the same time. So, how should such a person go about constructing a portfolio?
Right. So it is actually very important, to have some money in a bucket which actually gives you the growth kicker, because we are talking about 30 to 40 years in retirement. So that is a ideal period where you can have exposure to assets like equity. So typically the strategy that is followed is known as bucketing. So in this, what happens is you create 2, 3, or 4 buckets. Now each planner would have a different kind of strategy structuring of the strategy. Essentially, what the strategy does is, suppose we're talking about 3 buckets. So the first bucket will have money to last for the next 3, 4, 5 years, whatever is your comfort level. Keep that money there. That is agnostic to whatever happens in the market. So it could be in a liquid fund. It could be in a fixed deposit, depending on your tax rates and other things that we calculate. So that money is something that comes to you every month on a regular basis without getting impacted by the external circumstances. So you are at peace that you will not have any change in your lifestyle. The second bucket probably could have something like hybrid mutual funds, or you can even consider shorter period schemes like, say, the senior citizen scheme which is available, or maybe the Vaivandan which is available. So that could be in bucket 2. Bucket 3 would be purely equity products. So it could be stocks, it could be equity mutual funds. You could put that into bucket 3. So whenever the bucket 1 is getting empty, you refill it from bucket 2 and bucket 3. So whatever profits are coming out of bucket 2 and bucket 3 can go into bucket 1. So that bucket one is continuously, updated from the profit. So this way, what happens is you are managing your asset allocation also, because when the equity goes up, you sell and you put it into debt, right? So you are taking care of the asset allocation. At the same time, you're providing the peace of mind that there is enough to meet the liquidity requirements at any point in time. And the growth bucket obviously keeps growing. So next 30, 40 years, you will have sufficient money still left with you.
Mm-hmm. So there's something coming back as well, just not spending everything,
Right.
right?
Right.
Growing. So should one make use of immediate annuities? Like, what are the few pros and cons, and what portion of one's portfolio would you recommend people to invest in immediate annuities?
See, what annuity provides, I think, is more of a psychological benefit of a fixed amount coming in for a lifetime. So that is, I think, the biggest
Like a salary
importance of.
hitting your account.
Yeah, so whether you're
Yeah.
taking it monthly or annual, there are
Mm-hmm.
several options that are available. So that gives you a psychological kind of, solid bedrock that I know this money is coming, nothing is going to happen to this. On the other hand, what happens is you lose liquidity, because whatever you're putting into annuity funds, that is going to come back to your nominees after you. So depending on what option you have chosen. So typically it is after you, the nominees get the money. So even if you want to withdraw in between, there are a lot of terms and conditions to that. So most likely it is locked. For your lifetime. You don't have access to that. Second, the annuity rates currently are not that great. So you get similar rates or better rates in say debt funds, or even for that matter fixed deposits, and that is taxable. So what you actually get in hand is much lower than what you see. So rate of return wise and taxability wise, annuities might not be a great choice to have. Having said that, it also depends on what amount of corpus that individual has. So if there is a huge corpus, which is, there is no issue of any shortfall, or even if you put a large chunk into debt, uh, it will not matter. So in that scenario, yes, annuities could make sense, but typically what happens is people have lower resources and higher demands on those resources. So in that scenario, you should look at alternate investments before actually looking at annuity. So
Okay.
there could be, debt funds would be much better in terms of taxation and liquidity aspect. So you have to create a balance. Now each person will have a different comfort level on that. So depending on that, you can make a choice.
Okay. So which is our one product which is good for generating a regular income?
For me, it becomes a SWP strategy from mutual funds. I think that is
Okay.
one of the best ones, so that is currently available. It is tax efficient, it is liquid. It is a little difficult to understand because the concept is very different. The taxation becomes different because it is capital gains that are accruing. So in a fixed deposit, when you get a certain interest, it is totally taxed on your tax slab. Whereas in a systematic withdrawal plan, the amount that you're withdrawing is a combination of your capital and the profit in that. So when you do that kind of calculation and you're holding the money for a very long period of time, your taxation goes much lower. So if you're in a 30% tax bracket, you could end up as low as anywhere between 12 to 15% on an ongoing basis on taxation in the SWP strategy.
Right.
And of course, there is liquidity because these are debt mutual funds you're talking about. You will have liquidity. If it's a liquid fund you're talking about, next day you get your money in your account, one working day. So that way it's very liquid. So a combination of liquidity and tax efficiency, I think makes it one of the very compelling products for retirement withdrawal strategies.
Okay. So one should use debt mutual funds over equity mutual funds when it comes to SWP.
Yes, I would say so, because equity is a very volatile asset class. So, if you are withdrawing from equity and there are periods of market, downfall, where the principal itself is going down. So you're eating away into your principal much faster. Whereas debt, in the shorter range, say maybe liquid, ultra short and low duration kind of categories, the volatility is much lower. You wouldn't really see your capital getting eroded largely at for most period of the time. So I think that makes it a better choice than doing a SWP from an equity fund.
Okay. And where should one invest the portion of corpus that should keep growing.
See, growth assets are
Mm,
two asset classes which we spoke about. So one is equity and one is real estate.
right.
So typically in retirement, we would avoid real estate because it has its own challenges, as we discussed earlier. And it will be difficult for people at that age to maintain the real estate also, because maintenance is another responsibility that comes through, and children might not be willing to do that, or they might not be able to do that, being in a different
Right.
city or in a different country altogether. So for that reason, real estate becomes a little more difficult. Equity is much simpler, so that even if you are moving cities, even if your children are staying abroad and you are probably moving in with them at some point in time, you are still able to maintain that portfolio. And also from a estate planning point of view, it becomes easier to move the financial assets to the next generation. So
Right.
from that point of view, if we talk about growth assets, equity versus real estate, equity becomes a much simpler transfer intergeneration. So I think from that point of view also, equity makes better sense.
All right. All right. Thank you so much for your time and inputs and all the information and advice that you've given our viewers today. Kiran, was lovely having you at Business Standard today.
Thank you so much, Bindisha.
Thank you.